a section of your textbook here that just talked about the Basel Accord and the requirements it had for risk weighting assets. So why don't you guys just dive on in, read that first paragraph, and some of it is stuff we've talked about already. So, capital ratio. What is that? What is the capital ratio?
The amount of capital over total assets.
Over total assets, yes. So that's one thing we need to have here. So capital over total assets.
I guess I have a question on the $10 million loan commitment. They balance that out by boosting checking or checkable deposits, or to make this accounting equation work out, do we just add 10 to bank cap?
Well, what do you think? Where's our accountants? Let's see. We're short one. So we got Kate and Katie. Who else is accounting? Jesse, yeah, that's right. You. So, loan commitment. Do we do anything on the balance sheet? What does a loan commitment mean?
Does that mean they're going to give them that $10 million, but at a later date? Or?
Yes, at a later date, yes. So they've made a commitment to loan somebody or something funds. This was, they said it was a commercial loan? Yeah. So, balance sheet effect.
Wouldn't it be a liability?
Yeah, is it a liability right now at the time the commitment's signed?
I mean, isn't it set up in a contract, so you're like signing into it? Or is this something you could back out of?
Good question. It is something that usually there's some conditions to be met. So it's not officially on the book. It's not a loan, so it's in this kind of beginning phase. What's that? So it's not a liability?
I would still classify it as a liability.
Does it belong on the books right on here,
It should be in the notes
or?
section.
Okay, in the notes, right? So the when banks get engaged with lending, they'll often get a loan commitment with a laundry list of stuff. So it's meant to make the borrower feel a little better that they've got at least one lender. But it wasn't uncommon for me when I was doing some real estate deals to get multiple loan commitments. So we might be playing a couple banks off of each other. So it might go in a notes section, but it doesn't affect your balance sheet right away. So.
So the point being that there's no changes to the cap ratio or the weighted risk ratio.
On the rated risk ratio, it'll have an impact. So calculate the bank's risk-weighted assets before and after the agreement.
So for the capital ratio, does it change?
No. So go ahead and calculate the capital ratio. What did you guys come up with?
5.66%.
5.66. So we had total assets of, what was it, 109? 106.
So when you said no, do you mean no, it doesn't change, or no, you're not right?
Yeah, it doesn't change the capital ratio, but the risk-weighted part does. So that loan commitment does get calculated into the risk-weighted assets. So in other words, the auditors, when they come in, the bank examiners, they want to know where you stand with your loan commitments outstanding that are out there. So they're going to factor that into your risk-weighted assets. So what'd you come up with for risk-weighted assets?
Before or after?
Before. 12%? What's in your numbers? What's the actual amount of risk-weighted capital, risk-weighted assets? So that's kind of what we're calculating is.
From the description, it seems like nothing that'd be in there would be commercial loans, maybe.
And what got the other weights? Anything?
I don't think so, because we have required reserves, which isn't anything that needs weighed. We have excess reserves, which isn't anything that needs weighed. And T-bills, which is considered zero risk, would be the first category, so it also needs zero weight.
So what does zero weight mean?
Risk-free.
Risk-free, right? So that's one way to think about this. We're weighting the assets according to how much risk there is, and we're going to put. I like to kind of look at it with the formula to think, okay, how much of my assets am I going to put 0% weight on because there's zero risk? And so a bank is sitting on these excess reserves, which is just kind of a pile of money ready to be loaned out, right? And it's really coming from, of course, the deposits of other people. So it's really other people's money sitting there, right? So, but they have the ability to loan them out. So that amount gets 0%, and what's that amount? $56, right? 45 plus 8 plus 3. So 56 million of our assets aren't going to be included in the calculation. if we think about kind of the full spectrum. And then the commercial loans are gonna get that 100% weight. So giving us $50 million of risk-weighted assets. And then after the agreement, we're gonna just throw that extra 10 in there. And then our risk-weighted is gonna jump to 60.
What's that, Tim?
It's really the second question, calculated before and after. So once the loan commitment's made, it is gonna be factored into your risk-weighted assets. And so you've still got 50 that you had before. I didn't show the whole equation here, but we're adding 10 million onto it.
Oh.
And that 10 million's getting weighted the 100% as well.
So then wouldn't that make like the actual percent, like 50 divided by the total, which is 106?
Yes.
The overall total? Okay.
Yes. Yeah. Well,
Like,
if you're calculating the risk-weighted capital
Right.
ratio, then that would be changing this number down here. Total risk-weighted assets would change to the 60, yeah. And then what happens to your capital ratio? The risk-weighted capital ratio. Does it go up or down?
When they go down, the denominator's gonna grow.
Right, the denominator grows. So if we take our bank capital of 6, which is staying the same, it's 6 divided by 50 compared to 6 divided by 60. Right? Which is worsening our capital ratio,
Is that just like a
risk-weighted
sign?
capital ratio. What's that?
Is that like a sign?
Yeah, I didn't ask, yeah, that wasn't asked in this particular problem, but that's the idea. And then you can see if the maneuvers as if the bank sells the T-bills, if they get cash in for T-bills and makes a loan, then all of a sudden we're sliding some of this 56 million. If we take 20 of it and slide it over here, then that's going to change our risk-weighted assets again, right? So kind of just think of jockeying the portfolio, and this is how the regulators are going to be, or in part anyway, regulating some of the risk at the bank. And this Basel Accord is something that's worldwide, so they're trying to kind of establish some general guidelines globally. Okay, any last questions there? All right, let's flip it over. A little more detailed problem. Old Hat Financial starts its first day of operations with $9 million in capital. A total of $130 million in checkable deposits are received. The bank makes $25 million commercial loans. The bank makes a $25 million commercial loan and another $50 million in mortgages with the following terms. 200 standard 30-year fixed rate mortgages with a nominal annual return of 5.25%, each for $250,000. Assume that the required reserves are 8%. What does the balance sheet look like? So you can kind of work together on this and try to chunk out a balance sheet with that information, little assets and liabilities, similar to what was done on the other side. Kind of use that as a guide.
I start leading people down the wrong path when I do that, right?
Yeah, I think. Let's see. Yeah, 139. Yeah.
Yeah, 'cause I combine.
You just combine,
I
or they
separate.
combine the loan. Yeah, you kept them separate. So yeah. 6.47.
And I weighted them right too, so. Okay.
Yep.
Good, sweet. Russ.
Yep. Calculator. Okay. Yeah, this is the calculator. How do you do?
Stuck.
139. This looks good.
As far as
now,
I
you
got.
now you got to get that
I
to
know.
come up. So you got a little bit, you know, as well as anybody, assets got to equal
I don't really know.
liabilities and bank capital. So these two columns got to add up together. It's one way to cheat, right? So you got, because you got the bank capital plus the liabilities, and assets got to equal liabilities and owner's equity.
Mortgage.
I don't know what this really is telling me.
Mine is too, so you're not alone. So that's what I want you guys to think about, the stuff that goes on the balance sheet. So we've got,
Anything else that's
the bank
extra
makes
on
25
it?
million and 50 million, and then they just kind of have these terms of how much they had in residential requirements. Yeah, so what is the rest of the balance sheet? That's the part you need to kind of complete. Because, you know, what's in there, I guess, is you've got required reserves. Remember that? 80%. Where was that? That was stated somewhere, wasn't it?
It's right there.
Yeah.
It's right above it.
So that's the one thing, the beauty about accounting is you can kind of backdoor yourself knowing that assets got to equal with
Do we have to do anything
liabilities.
with that mortgage?
So yeah, it looks good. What's that?
Do we have to do anything with that mortgage
No.
information? Okay,
No.
cool.
So what'd you get for required reserves? 10.4. And so then what's left over? So if we got required reserves of 10.4, and we've got our asset list. We know that we want to get to so we've got checking deposits. Of the 130. And we got the bank capital of 9. So since we got the 139 there, we need to fill in the blanks here. And those loans came out to be, and you could list them separately or together for this purpose anyway. 25 of one and 50 of the other. And then we've got excess reserves of the 53.6.
So basically that little leftover that is at the bottom and
What little leftover?
this stuff right here.
Right.
That was just a bunch of extra.
That was some extra info, yes.
I hate when.
That's good stuff to know for, actually.
Not necessarily, no, you need to pull them out for the risk, yes. So yeah, you do need to pull them out for the risk weighting. Residential mortgages carry how big of a weight? 50? So we got our risk-weighted assets equal 0% times 64 million plus 50%. How much was that? I got 0% on the 64 million of excess, right? And yeah, we got 50 million of residential mortgages, and then we're going to give 100% weight to our commercial loans. That is, yeah, calculate the risk-weighted assets. Do you see why? It kind of comes back to what we're doing with the risk weighting. So from this first paragraph, we've got residential mortgages weighted at a 50% risk weight. So they're relatively safe, or safer, so they're getting less weight than the commercial loans. All right, everybody okay with that? Yes, you could answer it that way, yes. Because that's the level of capital doesn't really tell us anything, right? So if we're looking at how well is the bank capitalized, oh, it's got 9 million. That all by itself means nothing, right? Because it depends on what their assets are and what other business they're into. So this risk weighting gives us a lot more information on what the significance of having 9 million in capital means for this particular bank. All right, good? Any other questions? So I want to talk a little bit more about Skousen now. Did anybody read ahead? To figure out what is, you got it done? No? So, I wanted to just discuss what his end, and you guys can go back and read it yourself.
Risk-weighted capital ratio?
Did what?
The second part of C is the risk-weighted capital ratio.
Right, so take your,
Very low, right?
yeah, take your bank capital and divide it by it. Yeah. So, John, what was his secret sauce? You read it too?
Invest in dividends.
Yeah.
Reinvest their dividends.
Okay. So, that's it. Stick to, that's one strategy that he does all kinds of investing. So, what are dividends? Those of you who didn't read it, that's fine, but what are, let's just kind of refresh our memories of what dividends are. Payments from earnings, right? So a company is, have some bottom line profit in a given period, whether that's a quarter or usually they declare them quarterly, but so each quarter they have revenues, expense, and there's net profit, and then of course they have to do some stuff with it. And the two choices are to retain some earnings, right? The accountant's got the retained earnings. What do you retain earnings for? Right, to do other things with it, right? To keep your business alive, maybe it's to buy a new machine down the road or whatever, or you just kind of have a little cushion of cash if you're in a seasonal business, maybe you've got a slow period coming up, and so you want to have kind of some cash reserves. So retained earnings is one thing that the business might choose to do, and then otherwise, if they have an appropriate level, they can choose to pay out to the owners, to the shareholders, and that's our dividend story. So why would that be something he would suggest for investing as it relates to some of the economic concepts we've talked about? Why would it be important to maybe just pick companies, or one strategy would be to pick only companies that do dividends? Well, that's what the company's not doing, though. That you might do that as the owner to reinvest, but when you're let's be clear on that. When you're reinvesting your dividends, what are you doing if you're an owner of this company? You can take that dividend payment and you can go run to the store with it, but if you're reinvesting, what are you really doing? Buying more stock from that company. Now, is that company getting that money, though? Be careful thinking about that. Is that company getting the money when I reinvest it into there? That's whoever's selling, right? It's a secondary market on the stock market exchange, so it's just somebody else who happens to own the shares if you're buying back into that company. So bear that in mind, that the company's not getting. So when the company lets go of that cash through the dividend, they're really letting go of it. I mean, it is money out the window. You might be reinvesting it, like we said, to kind of build up your portfolio, but the company gets nothing. So they are cutting cash. So why would he think those are companies that are good ones? Go ahead.
Appears that the state company.
Okay.
Paying out, so they're obviously earning profit.
It adds a level of stability, right? Yeah. And so it kind of signals that there is a profit and they have a commitment to that. Okay, good. Other thoughts come to mind on why that could be an important economic concept to chase?
By the time a company's declaring dividends, they're usually past their high growth period, and so as such, they also pass their growth trap period.
Mm-hmm.
And so they can either be at value or a little bit undervalued, which gives you a better chance of getting a bargain. You're not just getting all bidding up price for it.
Mm-hmm. So, what else?
Well, I think it's interesting just from hearing Dr. Craig talk about stocks because he's always kind of jokingly saying he wishes he got in on Facebook. But he didn't because he thought it was a crapshoot and it didn't pay a dividend and and it's
So he brought up dividends too?
yeah, and he said that it started at like what, like $7 or something. It started like low, and now it's like 85, and it's starting to come back down. But he was saying like, but he didn't because one of the big reasons was because it didn't pay a dividend. And he said the only reason he held on to AT&T is because it pays such a large dividend, even though it makes him uncomfortable because they have such a large amount of debt, but it's from like building towers and things that are for the company.
Right.
So he's able to kind of be like, okay, I guess that like $billions worth of debt is kind of understandable, but as long as they're paying my dividend, they're still fine.
Mm-hmm.
He said if they ever drop that dividend, he's out because of how much debt they have.
Right. But so they could drop the dividend and pay off the debt faster, right? Because again, it's money out the door. If they're paying a big dividend, then it's at the expense of this large debt that they have, whatever their interest rate is on that. But they could say, hey, shareholders, we're not going to pay a dividend for the next year, and then we're going to pay off this debt, and then we'll reinstate it after a year or two. How do you think people would respond to that? Like if you're a McCrite who owns it, do you believe them?
Based on that, I think that people are just dropping it, like that price is gonna drop, so.
Because we don't really know if it's credible, right? For one thing, to hold on a year that they'll start paying it, because after a year or two goes by, then they're like, oh, well, we didn't think that we really need these funds. As you can see, we have a very nice global expansion into Indonesia, and so instead of paying dividends, we're going to go use the money to go into Indonesia or whatever. There's always something, right? So from a human action standpoint, that dividend claim I thought was a neat insight, that it kind of shows something different about the companies. Any thoughts on the law of diminishing returns possibly for, we talked a little bit about this in the previous, I can't remember if it was plungers and peacocks or when we got into our discussion about spreading ourselves thin, or
We're talking about one company.
yeah, but we were also talking about McDonald's going into pizzas or something or what.
Yeah,
that was discussion.
Yeah.
Yeah, it was on the Chipotle. So, if they're not cutting a dividend, from an economic standpoint, is the business going to use that money wisely? So are they going to, do they know the best spot to put it? Or from society's standpoint, is it better that the money gets kicked out in a dividend and then us as the investor says, oh, this is a good company to put it into. They're growing. I've studied their underlying fundamentals or whatever. So we kind of, is it better to keep the funds there, or is it better to have the funds be released into the market to find higher and better use? There's no real good answer to that. I mean, some companies might reinvest those earnings well to grow the company.
I think it depends upon what stage the company's in. If they're still in their growth stage.
Yeah.
It's probably reasonable, and that's why most growth companies don't get it.
Right. Most of the small companies wouldn't have a dividend early on.
Apple didn't have dividends for really recently, right?
I don't know if Apple does or not.
They do now.
They do.
4 or 5% dividend.
Okay.
But they, I think it's just fairly recent, wasn't it? Is there a company that have those?
It's like a year or two, maybe less.
Yeah. Yeah, I think that's a good point. I think depending on where the company is in their life cycle does definitely make a difference. If they're in this growth mode and they got a great idea, then they probably don't want to be necessarily showing out a dividend.
What causes a stock split? They're doing really well, is that pretty much it?
If they-
Prices, sorry.
Go ahead.
I was gonna say, prices, a certain spot gets high, if it's so high that they're afraid that they're not gonna be able to get capital coming in, then it's enticement buyers more or less.
It makes it more liquidable being in a smaller denomination. So Berkshire Hathaway, Warren Buffett's company, originally didn't do any stock splits, and they still haven't actually with the A shares. They created these B shares later. But one share of stock runs, oh shoot, I shouldn't have opened my mouth because
It's like 147 today.
$147. That's for the B shares though.
For the B, not for the A.
Yeah. The A is like, I want to say,
It's gonna be expensive.
yeah, it's super expensive. Maybe I won't open my mouth. I guess we could go Google it quick here. But anyway, it gets to a point where in order to buy one, I know at one point in history they were $3,000, for instance, for one share. So in order to buy one share, you had to save up a lot of money to get in. And he kind of liked it that way, that it was somebody who was really committed to putting a large chunk of money with him. And then eventually they created these B shares, which was the smaller ones, so that's just a little more entry level. Yeah.
Like,
So
But
it's
anyway,
like
that's the answer to the
cost-
to the
so
stock
like
split.
The cost of the stock gets so high that they can't get as many people in, so they split it so it's cheaper per share.
Yes. Yeah, and then you. It also comes into play when if they do additional sale of stock, of shares, initial to raise money for the company. I think then there's some splits that are involved. You guys know that in accounting better than I do? 'Cause I'm not positive exactly how that works.
To raise capital.
If the company lets some of their shares go to raise more capital, I think that might cause something there.
They
too,
can
but-
resell them and then capitalize on that profit margin.
Yeah, okay, that might be, yeah, so that would be independent of the split though, wouldn't it?
Mm-hmm.
Yeah. So that's another thing to do, by the way, with earnings, is they can go to Wall Street and buy more of their own stock. and so they can own more of it. So that's another strategy for some. So his thought is, if you stick to just, and he's got some data in here that's kind of interesting. If you stick to only companies that pay dividends, you'll at least know that you're dealing with a company that's going to be pretty solid. And if you do the reinvestment of the dividend strategy, he shows them outperforming even some of the indexes. So, and that was on, if you guys have your books, there's a graph, 88.
Yeah, I mean, it makes sense given the long-term strategy.
Yeah.
Some people think it's a little bit counterintuitive that if you want to go for growth stocks, that you can put in, you can technically write it up or whatever, where you're just trying to do the long-term strategy, but it's almost makes no sense. It's like, okay, if you're going to do this for the long haul, these are things that are proven to be here for the long haul, so
Yeah.
you're going to continue to get steady income for it.
Committed to paying dividends, you've got that profit motive to kind of do things right, and you at the margin sloppy, I guess, and to be more efficient with your funds. If you know that you want to maintain your dividend and minimize costs, maximize profits, all of that stuff, it probably causes you to hone in a little bit better too, from a human action standpoint. And we're talking about, so we're reducing the principal agent problem. Back to the kind of the big broad brush, moral hazard and the principal agent problem, where you've got these people running the company for you. If we know that they're committed to paying a dividend as part of the overall structure of the firm, then that minimizes some of that issue, or at least chips away at it.
Being able to trade a lot of stock doesn't make some sort of insider trading information going on in there.
That's a good question. Yeah, I bet as long as I don't know if it's announced or yeah, they do it. So I know there's some carve out of some sort. But yeah, I suppose they'd be up for investigation if they bought it and then it went skyrocketed just before some information was released. It'd be very obvious, if they were doing that. But if they kind of announced early on that we're going to go through a buying program for the next 5 years, and no matter what the price is, we're going to buy, something like that. It's probably, they might even have to clear it with the SEC maybe first. I'm not sure. So I thought this was kind of, when I first read this book, I'm like, oh wow, that hits on a lot of economics from human action and otherwise. I have not switched myself, but I'm just learning about the products. In fact, I just asked Greg Moore the other day on what those are, whether our TIA CREF fund that we use for the university has the dividend, like do they have a mutual fund? So that's the other part he talks about, is not necessarily to go out and buy single stocks, but there are mutual funds that have within the portfolio only dividend paying stocks. And that's one of his recommendations, and that would be pretty solid too. So you're not single stock buying, but rather just you're purchasing shares in a mutual fund that has that strategy. And then usually, Greg told me you can choose to get a check cut off of it. So the mutual fund value is derived from the money that comes into the mutual fund, and then I think you choose whether to reinvest your funds, which what you're really doing is you're rebuying more of the mutual fund share, which has, let's say, 200 dividend-paying companies underneath it. And so then you're buying more of the mutual fund, which in effect is buying more of the dividend stock. So that's what I don't know. That's what I'm just starting to learn, because I think I'd like to put some of my money into that too.
So instead of that, when the dividends come in investing in more stocks, you get a check, you just keep like the same amount.
Yeah, that's what Greg said. So the mutual fund will have, for each share you own of the mutual fund, whatever the 200 companies paid out in dividends, you get your pro rata share of that check. And so some retirees do it that way. If you have dividend stock, that's their paycheck. So they'll take that dividend and live off of it, so that's another strategy people can take. So Okay. So if you haven't read the rest, you can tuck this away on your bookshelf and maybe look at it later, but it's kind of there's a lot of neat comments in it. And
Are we done with this for the class though?
what's that?
Are we done with this for the rest of the class though?
Yes. Yep.
Just read it on our own.
Yeah, just read it on your own. Yep. Don't sell it back if you're planning to sell it back. Wait till we're done with class. We might reference back to it at some point. So don't dump it
I
that
was
way.
planning,
But we might come back to it a little bit.
It was cheap enough for.
Yeah, it was at all.